Hey everyone, welcome back to Capital Finance, your go-to channel for business ideas, entrepreneurship, investment, and personal finance. The COVID-19 pandemic surprised the world as it changed and influenced a lot of things in our society. One of the hardest hit aspects is the global financial system. Property prices plummeted, interest rates are down, and stock prices are unstable. So in this video, we will talk about the effects of the COVID-19 pandemic on the US financial system. Now, it's easy to see that the previous 2 years have been some of the finest in the market's history when you look at the data. Since the collapse of 2020, the S&P 500 has grown by more than 100%. Nothing like it has ever happened before. Regular occurrences do not take place in this manner. According to historical trends, you may expect an annual increase of roughly 10% at the most. If we're to be reasonable, we can predict an annual increase of around 8%. However, as we entered 2022, January turned out to be very bad for us. A complete collapse of the stock market took place. An almost 10% drop in the S&P 500 was recorded. Anything and everything that was once successful has now failed miserably. Until March 2020, it had been the most challenging month of the year. On the other hand, the housing market has continued to thrive even while equities have declined. Meager loan rates have continued to drive prices higher and higher, and experts have predicted a catastrophe from the beginning. What factors are contributing to the housing market's continued expansion? What is it about the real estate market and why hasn't it collapsed? You'll find the answer to these questions in this video. Before we proceed, don't forget to like this video and comment your thoughts below because I'd love to hear what you think. The housing market is entirely predictable and can be simply regulated by the federal government. Because everyone needs a place to sleep, there is always a need for homes. Even if you have a place to live, a property is one of the finest investments you can make since it generates income. Houses are always in demand. However, the market fluctuates depending on the price. As a result of a stagnant economy, housing prices did not rise at all between 2017 and 2020. Investors might only notice a slowdown in the property market if it increased before 2017. When mortgage interest rates were in the 5 to 6% range, the demand for homes was much reduced. However, in 2020, the interest rates were nearly 0%, making mortgages considerably more reasonable. One of the best financial moves you can make is to buy a home at a 3% to 4% interest rate. When the price went up by more than 25%, it was because of that. Experts have long predicted that when those cheap interest rates expire, that demand will dissipate. But guess what? The Federal Reserve has never raised interest rates in the past 2 years. They managed to keep them at 1%. Rates were practically 0% at the time of this writing. Mortgage rates, on the other hand, have risen modestly since 2020. Chairman Jerome Powell, the former Federal Reserve's chairman, did indicate he expects a rate hike next spring. But that's far from guaranteed. The Federal Reserve seldom does what it says, preferring instead to withhold information to avoid causing market turmoil. Even though they have the greatest data available and know that the inflation is a concern, they maintained reporting that inflation was around 3% to ease everyone's worry. Regardless, the question is not if but when interest rates will rise. It's been done before. It is unsustainable for inflation to be more than 3% at the end of the day. The most important question is whether or not the market will collapse if interest rates rise. The most likely outcome is that you are incorrect. The number of houses for sale has dropped considerably after the financial crisis of 2008. Since then, there have been many fewer new residences being developed. It was clear to the government that we would witness another catastrophe if it wasn't going to manage the housing market. Therefore, the supply of houses was already limited, which kept real estate prices rising steadily. On the other hand, the outbreak wiped off the remaining supply chain. Even though the pandemic has been present for over 2 years, the supply chain has yet to fully recover because there aren't enough properties for sale. Even if mortgage rates rise significantly, they won't impact house prices. Building this supply network began at the end of World War II. The ingredients for a single timberland boot, for example, would be sent from 5 or 6 to a facility in Thailand, where they would be produced and distributed throughout the world, including the United States. Because of this, the supply chain can be harmed by isolated manufacturing. To be ready for another pandemic, firms are redesigning their whole supply chains by moving their manufacturing closer to where the final product is marketed. Until we learn how to live with this virus, we won't be able to do that. According to a poll, nearly all house-building enterprises cited supply chain issues as a significant source of frustration. Building a house takes longer because of a scarcity of available materials, and the delays and increased input costs are causing housing prices to rise. Since at least World War II, the situation has been the worst it has ever been. These aren't the only things to take into account, of course. It's becoming increasingly common for corporate companies to own rental properties, which reduces the availability of housing in the market by about 18%. Inflation, on the other hand, is by far the greatest danger. Inflation has a profound effect on the human psyche. People are less inclined to sell a house if they believe it will rise in value in the near future. What are you going to conclude from that? Prices will continue to increase as long as there is a shortage of available housing. There is no sense in selling your home now when you can get a 12% increase in value by year's end. Until inflation or supply networks are restored, it is unlikely that property prices will return to normal levels. Nevertheless, why haven't interest rates been raised by the Federal Reserve? In addition to combating inflation, the Federal Reserve must also ensure that the economy expands. There has also been a lot of uncertainty in the previous 2 years. Vaccination appeared like a simple solution at first. Still, the government struggled to get enough people vaccinated, and new strains of the virus that were not protected by the current vaccine kept emerging. Consequently, the problem remained. For the third time, by the time we worked out a way to cope with the new strain or persuaded others to be vaccinated, some of those who had already received it were forced to get re-vaccinated. Despite the best efforts of the government, it will never be resolved. There is no way that we can completely eradicate this virus, and even if we could, it would cost us so much money that it would be pointless, so we're learning to live with it instead. As a result, the Federal Reserve has decided to keep interest rates low until it is obvious how the economy will respond to these new regulations. We can predict that costs will not rise by more than 12% this year. It's likely to be in the 7% to 10% range or even lower. Another reason we shouldn't expect a property crisis this year is because even those who can't afford their mortgage payments may still sell their homes for a profit because of the lack of homes on the market. Things will become a lot clearer if the Federal Reserve succeeds in keeping inflation at around 2 to 3%. These projections are based on the reality of the situation on the ground. What happens in the future will be revealed only with time. I hope I was able to answer all the questions. If you like this video, subscribe to Capital Finance and click the bell button to get updated. See you!